What does volatility in the markets mean for public and private markets candidates? Should they be concerned about volatility of their seats? Is a return to seemingly normal or expected results on salary and bonuses for 2024 going to create natural attrition or an opportunity to find stability? Let's talk about it on Searching Smarter. Every year at Selby Jennings, we survey thousands of financial sciences and services professionals across the USA to benchmark salaries, the benefits they receive, and which factors would cause them to leave their company or entice them to join a new firm. Today's conversation is with Nick Saglimbene, who leads our public and private markets recruiting team here in New York. If you're interested in reading the full report, it is linked in the show notes of this episode and available at selbyjennings.com. Hey, Nick.
Hey, Jesse.
Thanks for being here. So first things first, and this is kind of, from the conversations that we've had throughout. The first question, just generally, obviously we highlight salaries and salary increases, bonus payouts, if there were bonus increases or not. First question I have is, were they consistent with what you have seen or experienced or heard from your conversations and your team's conversations with candidates?
Yeah, I think the report, the findings in the report were consistent with what we've seen, from candidates in the market. I think that overall 24 was a better year in terms of performance across most strategies and the overall market. So candidates were happier and, to some degree, their expectations were met at least much better than they were in 2023 when bonuses were down or non-existent.
Great. So according to the survey, in the respondents in our survey, 57% of investment management respondents received a salary increase. Does that seem low to you? Does that seem consistent? Not necessarily if they received the increase that they wanted, more just like a little above half of the industry kind of getting a salary increase. What are your thoughts on that?
Yeah, I think that probably makes sense. I think that as you become more experienced within the investment management space, the base salary doesn't necessarily, it may move incrementally, if at all.
Yep. Okay.
A bulk of the raises will happen more at the junior levels, analyst or associate to VP, those types of promotions.
Got it. So that probably leads us to assume, and I think this is also in the report actually, but it probably leads us to assume that a majority of our respondents were more junior candidates, kind of sharing, the situation then.
Yeah, it's possible. I mean, if 50% of the candidates received, raises, then at least half to a little more than half may have been on the mid to junior level.
Got it. Now, expectations, obviously we, talk about whether they receive something or not. Expectations wise, would you say just because something met expectations, would you say then that candidates were happy for the most part, right? Maybe, if they were expecting a lower performance bonus and they got it, that doesn't necessarily mean they were happier with it. So what's the general sentiment been in the IM space with regards to happiness around or contentedness around salary increases and bonuses?
Yeah, I mean, I think recency bias is a real thing. So I think they're probably happier from this past year than they were from the previous year. I do think that the candidates in this space do tend to have high expectations. So even if, the minimum expectations were met, some of them may not be thrilled or they may not have had their expectations fully met. But I do still think that most candidates are happier this year than they were last year. So they can definitely keep that in mind. And there's that recency bias to being happy.
Got it. And I know this is something that you and I were actually just recently talking about. There was an article from eFinancial just this morning about kind of like their bonus report findings kind of thing. And across hedge fund industry, across private equity specifically, pay was up almost 50% year on year. And that's across various levels, across various kind of like pay scales. To the point that you just made, would you say that, the recency bias, would you say it's kind of like because 2023 was down and now 2024 is a return, almost like a regular increase to 2022 kind of thing?
Yeah, I would think that those numbers, the 50% year over year numbers are due to, bonuses, especially in private equity, for instance, where bonuses likely could have been zero in 2023. And hedge funds, potentially not a great year of 2023, but at the end of 2024, it seemed like, the market was humming. So I do think that's probably a little bit more of a return to normal, although this year is probably anything but normal as well.
Yes, which we'll get to in a moment, again, as we record this conversation towards the end of April. We've had quite a month, so definitely want to get to that. Just before though, we kind of touched on private equity and the hedge fund space. Other hot areas I noticed, and we don't really cover this specifically in our report, but again from this EFIN report, that private credit pay, it increased, but not a ton. Private credit is an area that we have seen a lot of activity in over the last couple of years, and it's an area that we've increased our client base and have had a lot of success in. Just touch a little bit on what you're seeing in private credit right now. Were candidates happy? Even if it was that nominal increase as far as total pay or bonuses are concerned, are we still seeing a lot of activity there? What's the situation with private credit?
Yeah, I mean, still a ton of activity in terms of hiring, still tons of activity in terms of fundraising, and firms launching new private credit strategies. I think the reason for there not being a major increase from 24 to 23 is there wasn't a huge down year in 23 in terms of those bonuses. So it's just been more par for the course and consistent, type of bonus and compensation packages for people in that industry. I think the expectation is that industry will continue to do really well in terms of, during periods of elevated interest rates. And overall, it seems like, that strategy and that asset class will continue to expand, and more firms will be attracted and more investors will be attracted to it as well.
Yeah, it's obviously been, as you say, super active for us, and we're starting to see it in various places, right? Especially the banks are kind of catching wind of it and picking up on that private credit firms have a lot of market share as well. So it's kind of everywhere, as you say, which leads me just to open that up a little bit more, a combination question, I guess, like other hot areas. And as we mentioned, kind of where we're at in the world right now, end of April, volatility, which again, something that you and I previously discussed, but like volatility, normally good, right? A lot to trade on, a lot to invest in or look for. In this case, would you say that volatility is A, impacting those kind of hot areas that you want to talk about? And B, is volatility good for the market, good for investing opportunities, and good for, activity as you're seeing with the candidates at this point right now?
Well, I think volatility always naturally just causes any candidate to pick their head up and, see what else is out there. I think it always will drive a candidate to question, is their seat volatile? I do think that volatility is potentially conducive to the investing world. Obviously, for traders and hedge funds, they do tend to capitalize and take advantage of volatility for the most part. I think it also, even from the private equity or private credit side, it allows investors to potentially look at assets at a reduced pricing point. So maybe resetting valuations. It's tough to say. It's not black or white necessarily, whether it's
Right.
a good thing or a bad thing, but I do think it's a good thing in terms of candidates being on the market. And it usually is an opportunity for hiring managers or clients to, hire more professionals, just given there's a larger supply of candidates who are on the market.
That's a really good point that you're actually kind of read my mind there with what I want the kind of last question to be. We've obviously talked a lot about the candidate side, and volatility could create some volatility amongst candidates, not just trading and investing opportunities. But you alluded a bit to the hiring managers and what clients might be able to look out for, or what they should look out for. Any just additional commentary there with regards to the current state of affairs, with regards to just the general post-bonus announcements and payouts, anything that clients or particular hiring managers should be aware of or be on the lookout for with regards to procuring and securing talent right now in this volatile market?
Yeah, I mean, I think the obvious one is being competitive with comp, and that usually goes without saying. So I think to skip that one, if you're not going to be competitive with comp at street level or at market level or above, then you just got to know what other songs to sing, right? So I think talking about seat longevity, maybe your personal track record of growing and developing your team. If people are worried about their seat, for instance, if somebody's making a ton of money, but they're in a volatile seat, they potentially will take less money for a less volatile seat where,
Yep.
they'll be able to make it through the day without, biting their fingernails every 5 seconds. So I think, yeah, you just have to know what levers you need to pull when you're selling to candidates. And if you're not competing on comp, what are the other factors that candidates do value? So longevity and C. I think flexibility for more experienced candidates. So if there's somebody who's autonomous and experienced enough, whether they're call it mid-level to extremely senior, maybe they have a family, they're commuting from outside of the city into the city. I think some of those things can go a long way for people to kind of have some form of balance in their life, but still be able to contribute in a meaningful way.
That's a really great point, and one that I actually do want to touch on very quickly, because we do cover benefits in the report amongst other things like coverage and things like that. Obviously, return to office and flexible working is huge in every industry right now. Generally, what are you seeing? Like you use that as a potential lever for candidates to be able to pull, or for clients to be able to offer. Are a lot of your candidates 5 days in, or a lot of your clients offering or enforcing 5 days in? Are there opportunities for more senior individuals to be home? Are revenue generators only required to be in 5 days? What's the general situation with regards to flexible working in the IM space?
Yeah, I mean, I'd say it's still a mixed bag. I think that there are probably your big corporate, either investment banks or asset managers, maybe who have a ton of exposure to real estate and are really emphasizing people back into office. I think that it's fairly normal for there to be some form of hybrid, whether it potentially just 4 days in and 1 day out. Usually that's going to be Friday, but offering some form of flexibility. Hey, if you're going to be traveling, if you have things going on, you can use your day elsewhere. And then we tend to see most of the junior level employees actually probably sticking to more of at least a four days in, 1 day out, potentially 5 days in. Those are the people who are at the point in their career where they're developing and, learning from the big guns, if you will, who are sitting next to them and teaching them everything. So, but we are definitely hearing a lot of ongoing conversations whenever we get briefed on a new, job or client. The situation is this, that's to be determined. It's likely to change, at some point in the near future. And I think that's just being, cautious about what they pitch to a candidate, when it very well may change within the year.
Yeah, makes perfect sense. And interesting, consistent for the most part, yet interesting as a lever to pull, at certain places, because sometimes, as we've seen kind of coming up, that lever might not be as much of an option. So interesting in this regard here. Thank you for the insights, and thank you for taking the time to talk about them.
Thanks, Jesse.
That's all for today's episode of Searching Smarter. If you found this conversation valuable, be sure to subscribe so you don't miss an episode. Until next time, keep searching smarter.